Hello, everyone, and welcome to the July 2025 Indie Wealth Market Update and Outlook piece. I'm Jeremy Bryan, CEO of Indie Wealth, and today we're going to do a little bit more of a robust look at what's going on in the markets and just what we see as the remaining issues for the second half of the year and some of the opportunities and some of the threats we see. So, without further ado, let's get started. So, we're going to start here with asset class performance. The overall asset classes have been pretty strong. If you were just looking at this in a bubble and saying, if you looked at January 1st and then you looked at now, you're like, yeah, that's a pretty good year. The US market was definitely a little bit of a roller coaster ride, though, in the first half. We did have a correction of nearly 20% in April before now rallying and being up, single digits so far this year, which is pretty strong for a first half. But looking at international stocks, you can see their performance is significantly stronger than that. So they really rebounded aggressively this year after having several years of underperformance, to be completely honest with you. So a lot of the international strength, to be frank, is coming from the fact that the dollar is getting cheaper. And usually that's a pretty good headwind, a pretty good tailwind for international stocks overall. So I think that's been a helper, but also just the significant differential of what we're paying for international stocks versus what we're paying for US, I think has been a bit of a tailwind as well. But you can see the first half has been very, very strong for international stocks. Lastly, bonds are still doing pretty well, considering of all the inflation and tariff talk, and we've had pretty decent level of bond volatility, especially at that 10-year treasury rate, has kind of fluctuated quite aggressively throughout the first half of the year. Still, the number is pretty good. We're over at 4% year to date, and that most people would take that for a bond market, especially given the issues and concerns that have been out there. So first half, pretty strong. A lot of stuff in the positive territory, not a whole lot of stuff in negative territory. So overall portfolio should look pretty good this year so far. Turning to economic growth, this is long-term economic growth here, but I really want to talk about short-term. When we look at GDP, we're really looking at a snapshot of history. There's not a lot of, we'll get into what GDP now is. I talk about that in a second. But we're really looking at is what is growth here recently and what has it been compared to long-term history. You can see we don't have a lot of long-term history where we have significantly negative contractions. The COVID elements there is what I like to call a little bit of a chart breaker because it makes everything else look tiny by nature, just because they had such massive fluctuations during COVID. But you can see we had actually a slight decline in Q1 GDP, minus 0.5%. Now, are we in recessionary conditions as a result of that? I think not at all. As a matter of fact, if you just look at the estimates for Q2, which the Atlanta Fed does what's called GDP Now, they provide real-time estimates about what they think the quarterly GDP growth rate would look like. We're seeing 2.5% growth. Now, that number was higher earlier. It's starting to come down a little bit, but it's still reflecting a growth trajectory. And that's what we think we're in right now. We think GDP is probably likely to grow, but probably likely to grow at a slower pace than long-term average. Tariffs will have an impact on that. We'll see how much and how aggressive that would be. I think that's my primary concern right now, is if we see tariffs reenacted and re-aggressive, if you will, that could lead to a little bit higher of concern in the overall markets, a little bit less spending, and just have a dramatic impact or a more aggressive impact on GDP growth in the future, which could lead us into decline and potentially into recession. I don't see that as base case scenario right now. I think we're at slower than average growth, but I don't see recessionary conditions right now. This is why. Really, if you're asking me about why I think economic growth has held up pretty well, is unemployment rates. Unemployment rates have been very low by historical standards, and still now. We just had an unemployment report come out today here on July 3rd that showed, again, the unemployment rate is 4.1%. Now, that fell from 4.2%, but there was some funky stuff in there. But overall, 4.2% or 4.1%, either one you want to use, is still a relatively strong number overall. It means that by general estimations, the U.S. consumer is either employed or can get a job if needed. We're not as strong as we were in the past couple of years. We really had a very, very strong market. In fact, it was probably an overheated market in 2022 and 2023. And that's why you saw wage growth going up so much. And then that exacerbated inflation as well. We're not in that area anymore. We're in much more of a normalized environment and maybe even towards the end of a little bit of sub average growth. Again, I don't see a reason for contraction at this point. There's nothing that would suggest that we're in that territory, but we are watching it because the numbers have been, the job growth numbers have been coming down a bit just on the long-term averages. We're not re-accelerating at this point yet. We're more on a decelerating path. So we need to continue to pay attention to that because I think, and this is our opinion, is that US jobs, again, is the most highly correlated sentiment to our economic growth. Because from our perspective, if a consumer, if he has a job or feels like they can get one, they will continue to spend money, and that's great for our economy. So this is probably what we'll watch most closely in the year. And we do expect that unemployment rate number to slightly rise over a longer period of time. And again, that deceleration of job growth. Again, we're not talking about contraction, but even if you grew this from 4.2 to 5% unemployment, which I think is a little aggressive, even then you're still below long-term averages. So from our perspective, there is some slack left in the economy. We probably will see greater unemployment as we go into the second half, but we'll see. It's one of the things we're paying the most attention to. Turning to inflation, this is the consumer price index, both headline, which includes food and energy, and core, which excludes food and energy. Now, food and energy is pretty important to us because that's what we pay attention to with regard to what did the consumer have left to spend. Because our philosophy is the more the consumer can spend on the things they want to spend on rather than the things they have to spend on, like food and energy, the better our economy will be. So we pay attention to both. But really, I think we're in normalized areas for inflation right now. We have not seen tariff impacts go into inflationary reacceleration yet, which is good. It's still something we need to pay attention to, though. We're still relatively early in that phase about what those tariff impacts actually are and how that flows through to consumer prices. So while we haven't seen it yet, this is still the operative word. We need to see more data points. And I think that's what the Fed Reserve wants to see as well. Jerome Powell's basically said as much. I think we would have already seen Fed cuts. If we were at this number and didn't have the tariff concerns, in our opinion, we'd have probably already seen maybe one, maybe even two cuts already. But because of the tariff unknown and the fact that the Fed does not want to see a reacceleration of inflation, I think that's what led to the longer patience, if you will, and wanting to see more data points before they start on that cutting path. So here's the Fed funds rate right here, and this is what the Fed controls, and this is very highly correlated to short-term interest rates. Long-term interest rates, like your 10-year U.S. Treasury, is much more an economic sentiment type of approach, and interest rates fluctuate based upon that. Short-term rates fluctuate mostly just right along with the Fed funds rate overall. So in our opinion here, you can see it's a relatively smooth glide path down. I think those estimates are not very good and not very useful, to be completely honest with you. What they are useful for is telling you what the Fed thinks right now, right? But what the Fed usually ends up happening is that something in the economy causes them to have to make adjustments, right? The reacceleration of inflation would cause them to have to raise interest rates to try to control that. Or economic deterioration that got significantly worse would cause them to have to cut rates to try to support the economy faster. My point is, just overall in looking at this chart, is don't expect that actual line to occur. I think that's usually kind of a pie in the sky that, hey, if everything stayed exactly the same right now, this is the path we'd be on. It's helpful just to understand from that perspective where they think it would going, but really it's not a very good predictor of where interest rates will be in 25, 26, 27. So take this with a big grain of salt. And if you really want to know where this number goes, it's jobs and inflation you want to pay attention to. Are those getting worse or are those getting better? And do we have enough evidence to suggest that adjustments need to be made based upon those data points? Now, let's turn to the assets themselves. We're going to start with bonds here. So bonds still providing a decent level of income here. This goes back only to 2009. So what I would say from this chart is that's artificially low. These averages listed here that were higher than at this point right now are probably somewhat artificially low because from 2009 to 2024 was the first time we really ever experimented with a zero interest rate environment where basically you weren't getting any income for your fixed income. So there's a big chunk of that in there. I would call these rates that we're experiencing right now probably more normalized to average over a very long period of time. So while this shows that they're above average, I don't see the bonds as much of a value as this would suggest, where hell, we're getting greater yield than we have since, and than average since 2009. It's absolutely true, but I don't think it tells the full story. The other part that we're paying a lot of attention to is that bond volatility has just been higher. Basically, since inflation hit in 2022, bonds have been moving around, not quite like stocks, but pretty aggressively for the bond overall market. So, chasing excessive risk and doing things to get a small amount of incremental yield, probably not the best approach to take. But also understand this is not 2022 anymore, is that bond returns are likely to be positive unless we see a significant amount of interest rate increases or such economic deterioration that people start to worry about default. I don't think we're in either of those scenarios here yet. So the bond coupon values are pretty accurate to what you can expect from a long-term return of bonds right now, which is that 4 to 5% range, which is just fine over a longer period of time. Let's turn to the stocks now. So 2025 estimated S&P 500 earnings growth is about 9%. Earlier in the year and in the last part of last year, that was probably closer to 12 or 13%. So we've had a pretty substantial decline in the estimate. But still, take a step back in 2025, are going to grow earnings at 8 to 9%. That's not bad. I'll take that any day of the week, twice on Sunday. From our side, we think that's absolutely fine. If that number is accurate, the market can continue to work higher because 8 to 9% growth. And then as we go into 2026, if that's expected to, at this point right now, accelerate growth from there, that is a fine backdrop from the market. If you've heard us talk before, we believe earnings growth is the biggest driver of long-term stock market performance. It does not work on a year-to-year basis, but over longer periods of time, if the earnings are growing in the S&P 500, it's a great backdrop for overall market growth. And so the 8% and the 9%, and if 14% is absolutely accurate, or 13.6 for 2026, that's a phenomenal backdrop for the market. Unfortunately, I'm going to throw a little bit of cold water on that, is that in our opinion, we think that 2026 estimate is overly optimistic. We could see some growth from tax relief and those types of things from the corporate side. But overall, 13.6% growth off of a growth year this year of this substantial amount, we just think that's too high. So we think that number probably has to come down. We said this earlier part of this year too, and we've already seen that. And you can see that even when that happens, market's still somewhat okay with it. We're up this year. We're not down, even though the estimates have come down. How far can you play that game, though, is that stocks get more and more expensive as you continue to play that game. So you have to be a little bit careful about that. But overall, if we think, even if that 13.6% number comes down to 10 or even 9 or 8, probably still a fine backdrop. The market can still work in that scenario. It's if we start to see that 2026 growth number go to 5%, to go to 0%, maybe even go negative, that's when we have real trouble because the market is not cheap at this point right now. And this shows that right here. This is the market price to earnings ratio for the S&P 500. You can see it's expensive relative to history. We're at over 21 times earnings, estimated earnings. That's expensive. There's no question about it. If you look at long-term history, this is above average. What I will tell you is how we use valuation. We use valuation not for short-term market performance at all. The next 6 to 12 months, valuation really does not matter that much, or at least it doesn't take much into consideration. Things can get cheaper, always get cheaper, and things can often, even when you're expensive, can get more expensive. So understand that, that valuation, if you're using valuation and saying, well, the next year is going to be bad because market stocks are expensive, so I'm going to sell everything right now. It's a pretty poor strategy, to be completely honest with you. In our opinion, valuation provides a much better approach to saying, what does the long-term growth trajectory look like? When you're average from a valuation perspective, long-term market averages are probably what you can expect, that 8 to 10% range. When you're cheap, you can probably expect a little bit higher over a longer period of time. Let's say, you're in that 14, 13, 14 multiple. Well, maybe you be able to expect 10 to 12% over a longer period of time, because that market tends to revert back towards its long-term averages. So you'd get earnings growth and you'd get valuation support. We're on the other side of that right now, is that valuation is not much of a support. In fact, if you're talking about reversion to the mean, it probably needs to come down, which means you should probably expect below average returns over a longer period of time when you're paying this level of multiple. Now, there's a lot of valid arguments that would suggest that businesses are different than they were in the 80s, right? So we shouldn't pay that level of cheap multiple. And to a certain extent, I agree with that. But again, I'm a big believer in reversion to the mean to a certain extent. And usually with valuation, you usually revert and you go below and then you go above because people get irrational. At this point right now, I'm not suggesting that 21, 22 times earnings is the new correct multiple. I would have a little bit of a hard time with that. So my best guess on this one, my best estimate would say that we should expect somewhat below long-term averages. Now, again, if the market averages 8 to 10%, we might expect 6 to 8% over a longer period of time here. I think that's how you use valuation as a part of your long-term strategy, while understanding it has very limited influence and predictability in the short term. Turning to annual returns and pullbacks. This is one of my favorite charts. We're going to use this probably a lot, because a lot of times I'm asked, do you think the stock market's going to have a pullback? Yeah, I think it's going to have it at some point. I don't know when. I can't tell you. I wish I could, but it happens all the time. So this chart, I'll explain it really quickly, is the bars tell you what the end of year performance was, and the dots that are down below tell you the worst performance during that year. This year is a phenomenal example already. Now, we don't know what the year end will look like, but we're up on the market this year, and we've already had a 19% correction. So again, positive blue bar, but the dot is still well below. We've had a pretty significant correction, and we've rebounded off of that. That is honestly more frequently happens. Now, 19 is aggressive. You usually don't see that level and then a bounce back, but it can absolutely happen. 5% corrections happen all the time. 10% corrections are still fairly common. Now, again, that 19% correction, that doesn't happen quite as much. And the quickness of the rally is, to be completely honest, even surprised me a little bit. But again, you have to understand that the market usually recovers before the all clear signal ever occurs, right? Is that we rarely get an all clear signal. There's usually a concern just goes from one concern to another concern. But in this instance, you're never going to be able to time the markets based upon all clear signals. Well, I'll get invested when this is going away. When inflation is normalized, then I'll invest. Or when tariffs go away, then I'll invest. It leads you to a perpetual never investing, because there's always going to be the next thing to be concerned by. But you can see by these blue bars, we have much more significantly positive performance over longer periods of time, even when we have times that have negative, corrections, and sometimes even as aggressive as 19% as we've seen, and sometimes even worse than that. And we've still ended the year at positive areas. So staying within the market, staying invested is the better approach to this over the long term. And this is how I try to bring this one home, is I really like this chart. This is one of my favorite ones. It's historical stock and bond return ranges over 1 year and then other longer term periods. The reason why I use 1 year as the primary example is the shorter the time frame, the wider the outcome range, right? Is that you can set an average on this. Well, average market year return is 10 to 12%, right? You can set that average all you want, but you have to understand within a year we've had as much as 60 and as much decline as probably 50 plus, right? I mean, we've had significant declines during that period of time. The ranges for stocks is incredibly wide. It's a little less wide for bonds. And then when you blend them together, it becomes a blended amount of that. But you can see how different those range of outcomes are for that 1 year period versus when you get into 5, 10, and 20-year periods. That normalized range starts to come down a little bit, and you can be more certain about what that approach is, at least if you're using history as your guidepost for the future, which we tend to do here. This is why your time matters. This is why we use time-based strategies around everything we do. Because regardless of your risk structure, regardless of your goals, you have to have a time frame around it. You have to adjust the risk based upon the time you have. If you have 1 year and you're saying, I need this money in a year, it should be nowhere near the stock market from that perspective, because that is the wide range of outcomes is you could have half the money that you need in a year. So you have to understand where your time fits in here, and you have to set up strategies in your portfolios to understand the different time constraints that you have. Some of the time constraints are very long, where you can take advantage of the higher return, and get rid of that long-term volatility or use the volatility to your advantage, because that's how you achieve higher return. But as your time frame compresses, you need to reduce that volatility to increase your certainty of return. So this really brings that home, is that, your average is the longer you spend, the closer your range becomes. In a year's perspective, that range can be pretty wide. And so you have to increase your certainty by taking some risk off the table if you need that money in a year. So let's just talk about the path forward here. At IndiWealth, we do not provide forecasts. We're not prognosticators about what we think the S&P 500 will look like. We're not going to put 6,200 on it, and we're not going to do percentage returns on a yearly basis. We're not going to throw those things out there. It's not what we do. I am not a future forecaster. I'm an understander of what could happen, what I think is the best source of return, and we're going to set up positioning as a result of that. That's what we're going to look at here. And so from our outlook perspective, let's start with the political environment. Do we think the political environment is going to go away and we're going to have business and economic conditions be the predominant source of our news flow in the next 6 months? No, it's not very likely. Just our presidential allocation or person right now tends to really like to be disseminating. I mean, shoots from the hip, right? President Trump tends to shoot directly from the hip, and he disseminates that to the public, which can create swirling events as a result of that, right? The counter reactions, the reactions to the reactions, all that fun stuff. I don't see that reducing anytime soon. It just seems to be part of his personality. So understand that this is going to be continuing a part of what we're going to be dealing with regard to investments going forward. But also understand that usually over longer periods of time, that stuff means less and less and less. Is it can have an impact and an influence, but businesses tend to adapt and adjust. That's what makes them good businesses. Bad businesses don't adapt and adjust, and they die. So that's what we invest in. We invest in businesses here. We invest in good businesses that can, over longer periods of time, be efficient and adaptable and have a customer base that's loyal to them. That's what we want to buy here. That's what we pay attention to, more than the short-term influences that can be caused by political discussions back and forth. We do believe the Fed will cut. We think it's at least once this year. The estimate, the greatest estimate right now, the most consensus estimate is for 2 cuts this year. I think that's entirely possible. I don't think we'll get out of more than 1 to 2 cuts unless we start to see a pretty big change. And again, a reacceleration of inflation or economic deterioration that's getting worse than expected. Those are probably the 2 elements you see get out of that 1 to 2 cuts, right? So if you see a reacceleration of inflation, you're probably going to see them raising, not cutting. And if you see economic deterioration, 1 to 2 cuts maybe become 3, 4, 5, or maybe aggressive cuts where they cut 50 basis points or even more than that, because they're seeing something out there that the economy is deteriorating faster. We don't see that right now. So from our estimation, we think 1, maybe 2 cuts is fine. We would say 1 is probably more likely, and then 2 is, if we're still on the same trajectory, I think 2 is actually right. So we're looking for at least one cut this year, but we don't see the avenue right now of a major change in Fed philosophy or projections right now. Trade deals. Trade deals have been a source of market boom here recently, or at least a source of market positivity because of the tariff implementations in April that caused that correction. A lot of them have been delayed or eliminated as a result of trade deals. I think that's going to wane in the second half. I don't, market's pretty optimistic right now. We've seen, performance is positive, market valuations are pretty high. So from that perspective, the market's already pretty optimistic. So I don't see trade deals. I think the general consensus right now is that these tariffs will be delayed, adjusted downward, or at least no worse than what we saw in April. And I think honestly significantly better than what we saw in April. I think that's the general consensus right now. So I think trade deals and reducing and eliminating those tariffs or extending them outward or further delaying them, it's just going to have less and less of an impact because we're kind of already there. So don't expect trade deals, whether whoever country it is, you'll probably see the announcements and, hey, we came to a firm agreement, we got our amount. I just think that's going to have less of an influence on the markets in the future than it has in the first half of the year. Lastly, we're at all-time highs in the stock market. That is not a reason to sell, right? All-time highs are required and necessary for us to grow our wealth over a longer period of time. So all-time highs in and of themselves are not a reason to sell. They're not even a reason to say that we may have worse performance in the next year. In fact, evidence would suggest it's equal to better over a longer period of time once you break all-time highs again. So all-time highs in and of themselves, I don't worry about them. I worry much more about earnings growth and valuation, what we're paying for the stock market, how it's growing. Right now, again, the growth looks pretty decent. Valuation's a little expensive. That's why over longer periods of time, we would expect slightly below average long-term return. So from a positioning perspective, what would we do then? What do we do with that information? That's usually pretty important. We're searching for relative value. I don't think you need to succumb to FOMO right now, right? If you were invested in a balanced 60-40 portfolio, there's no real reason for you, let's say that's 60% stocks, 40% bonds. There's no reason for you to chase more stocks, right? To get to 70, 80%. Naturally, honestly, if the number continues to go up, that number goes up anyway. So you usually have to reduce your risk over a longer period of time because the stock market outperforms the bond market. But from the perspective here, there's no reason to chase risk right now. If you're 60-40, that's absolutely fine. If you've gotten yourself out of it because the market has come back aggressively and you took advantage of maybe the 19% decline, now's probably the time to get back to your equilibrium level of risk. I think that's probably the more prudent strategy, but it's also not time to take all the chips off the table. You're never really going to hear that from me. I don't think that that's something that's a worthwhile strategy. So from our perspective, it's much more searching for relative value right now than really taking a stance on much more aggressive risk or much more conservative portfolios. Fixed income, providing income right now, which is great. But again, don't extend out for a small amount of yield gain. Don't accelerate the risk. Fixed income is there to reduce your overall portfolio volatility and provide you some income. It's doing both of those right now. You don't have to take extended amount of risk to achieve a slightly greater amount of yield. I would avoid that, and I would stay in the course of maybe even a little bit more conservatism in the bond market right now because there's not a lot of incentive to take aggressive amounts of risk from these levels. So use your fixed income as what it's for. Again, reduce that portfolio volatility and generate some income. On the US stock side, I still think there are bargains out there, but they're a little more few and far between. It's a little harder to find them at this point right now. Market's expensive. Doesn't mean we sell everything. It just means that we have to understand that some of the stuff right now has worked very well and is pretty expensive right now. So maybe reducing some of those to buy some of those more bargains, that's what we'd be looking to do. So right now, one thing that I actually do see as a potential benefit later on is healthcare. We think healthcare might be a quote unquote buy the news type of strategy where if we get the bill passed through, the Congress gets the bill passed through, gets it to the president, and we have a budget bill. There's been a lot of concern with regard to what the cuts would be with regard to healthcare. Healthcare, as a result, has been one of the worst performing sectors year to date. I think there's an opportunity because the growth trajectory isn't changing aggressively. So, from that perspective, the stocks have gotten cheaper. There might be an opportunity to take advantage of a little bit of healthcare there. But those are the kinds of things. Again, are we going to swing all of our portfolio into healthcare? Absolutely not. But that's where some of the relative bargains could be compared to some of the stuff that's worked extraordinarily well at the early part of this year. Lastly, on international stocks, again, the performance has been very good after years of underperformance. So we have not even made up that ground yet, but it has had a really strong first half based upon a lot of it has been based upon, frankly, the dollar getting significantly cheaper, which again is a tailwind for especially emerging market stocks. So here's what we think. If the dollar stabilizes and goes the other way, I think emerging market stocks and maybe international stocks as a whole probably experience a little bit of flatlining and maybe even a correction environment. So I wouldn't be going aggressively into them right now, but I understand, and this is just general fact, is that US investors are heavily underweight international stocks. I think they need more proof that this is going to be a long-term sustainable trend, that it's not just the dollar trade that is causing international stocks to outperform. They have to see much more sustainable growth and things like that before they would say, okay, I'm going to take some of this US, which has worked extraordinarily well, and go into international, which hasn't worked quite as well. I don't think we're there yet, so I don't think you're going to see a big sea change of that allocation, but I do think there is room for that if this continues to go upward. So we are going to keep an allocation to international stocks. It won't be aggressive. We're not going to go significantly greater because we've frankly benefited from the performance we've seen thus far. But we're not also saying we need to pull out because we're going to have a massive correction environment. We think international stocks do have a fit within overall portfolios for that diversification element. And frankly, for the glacial pace of change, right? Is that US has been outperforming for a very long period of time. The prior 10 years before that, international stocks were very good for quite a period of time. But this has been an extended period of US outperformance. And eventually, I think something happens where international starts to show that. This may be the beginning of that, but I'm not betting the farm on that right now. So I hope this was helpful. I hope you got something out of this. We will do this one. We'll do our market update and outlook. Will be more robust on the quarters, but we'll do a monthly market update and outlook in July and August. It'll probably, or the end of July, or excuse me, early August, early September. Those will probably be more muted ones where we'll have a small update and recap. But every quarter we'll do something like this, which encapsulates a little bit more of a broader strategy and outlook. So thank you very much for joining us, and tune in next time where we'll have our next hot button topic and the next outlook that we see. Until then, take care and thank you.